In 1964, Warren Buffett made a colossal mistake. He bought a dying textile mill out of pure, unfiltered spite after a deal went sour. It was a disaster. Actually, that impulse buy became the blueprint for everything. By trying to fix a broken company, he ended up building a system based on brutal discipline and cold logic. It's the ultimate pivot. He calls it the internal scorecard. It's this mental wall he built to stop the outside world from defining his worth or his success. He just stopped listening. Most people live for the rush of a green stock ticker. But Buffett stays weirdly calm, watching the numbers climb and fall with the clinical detachment of a scientist. He's just watching. Think about this. He views the market as a manic-depressive partner named Mr. Market. Instead of getting emotional, he just waits for the guy to offer a price that actually makes sense. He's remarkably patient. By age 14, he was already playing a different game. While his friends were focused on school, he used $200 of newspaper money to buy a 40-acre farm in Nebraska. He was just a kid. This wasn't about being rich. It was his first real experiment with float, which is just a fancy way of saying he used other people's money to make himself more. It's a genius loop. Then he met Benjamin Graham. Graham taught him the cigar butt trick, finding nearly dead companies that still had one last puff of value left in them. It's a grimy strategy. Here's the lesson. Investing works best when it feels like a boring business. By stripping away the emotional rush of gambling, he turned the stock market into a math problem. It's almost too simple. But then everything changed when he met Charlie Munger. Munger was this brilliant polymath who basically told him that his current strategy was a waste of time. He pushed him further. Munger made a simple point. It's way better to buy a world-class business at a fair price than a mediocre one at a bargain. That shift changed everything. Look at See's Candies. This deal proved that a loyal brand matters way more than how many factories a company owns. It was a light bulb moment. Buffett is famously picky. He stays inside his circle of competence, which means he has the ruthless discipline to say no to things he doesn't understand. He just ignores it. People laughed at him during the dot-com bubble. He sat on his hands while everyone else got rich on tech, waiting for the inevitable crash to prove him right. He didn't blink once. He doesn't even use a computer. Instead, he spends his days sitting in a quiet office reading 500 pages of boring annual reports. That's his whole job. Now here's the trick. Knowledge builds up just like compound interest, so the more he learns about random industries, the faster he spots a win. It's a snowball effect. He treats Geico like a giant gas tank. He uses the insurance money, cash that doesn't belong to him, to fuel massive bets on other companies. It's a perpetual engine. This gave him a huge advantage in 2008. While the world was falling apart, he handed a $5 billion lifeline to Goldman Sachs on his own terms. He was the only buyer. He didn't just help them, he squeezed them. He demanded massive dividends while every other investor was panicking and selling everything they owned. He stayed cold. Buffett has a blunt definition of risk. He says it's simply what happens when you have no idea what you're actually doing. It's that simple. He still lives in the same house he bought in 1958. It cost him $30,000, and it's a physical reminder that he doesn't care about showing off. He's just comfortable. Even the McDonald's and Cherry Coke serve a purpose. It's a total rejection of the high-status nonsense that usually distracts people once they get some money. He's opted out. He treats time as his only real limit. His calendar is completely empty because he refuses to let other people's meetings dictate his life. He owns his day. This freedom lets him wait for the fat pitch. He sits there for years if he has to, waiting for that one perfect opportunity where the odds are entirely in his favor. Then he swings. His rule for stocks is pretty famous. If you aren't willing to own a company for 10 years, you shouldn't own it for 10 minutes. He's thinking in decades. Think about the 20-slot punch card. He acts as if he only gets 20 investments in his entire lifetime, which forces him to be incredibly picky. Most people overtrade. This stops activity bias in its tracks. That's the human urge to do something, anything, just to feel like we're being productive. He prefers doing nothing. Buffett's life is a win for temperament over raw IQ. Smart people are everywhere, but the ability to remain rational when everyone else is screaming is rare. That's the secret. He treats his shareholders like actual partners. Every year, he writes these letters that basically provide a brutally honest autopsy of his own mistakes. He hides nothing. The goal isn't to beat the market by a tiny bit. He wants to own the compounding machines that end up redefining the market itself. He plays a bigger game. In the end, he isn't really a stock picker. He's a philosopher who happens to be obsessed with probability and the way humans behave. Money is just the scoreboard. His legacy proves a simple point. Being absolutely right is infinitely more profitable than being first or being fast. He took the long way. It all goes back to that internal scorecard. There's a quiet power in knowing exactly what you're worth, even when the rest of the world disagrees. He's already won.